Normally, the average US citizen in their mid-20s has a retirement fund of about $5,000. What kind of cash dividend yield could you anticipate from a portfolio this size? You might be surprised at the amount of dividends that $5,000 will pay on its own, even though it won't be enough to fund a traditional retirement. Perhaps you could use it to pay for a getaway or to cover your expenditures. Look at the several scenarios that could lead to different income levels. This will give you a rough idea of how much cash you'll need to start living independently. Hence, in today's video, we will be talking about making dividend income from $5,000. So, if you're new here on Usable Wisdom, you came to the right channel, for we will surely help you kickstart your pursuit of great riches. Oh, and if you discovered something helpful from this video, it would be lovely if you subscribed. You can also unsubscribe at any point, but as long as you subscribe, you'll always be the first to hear about new money-making strategies as they become released. Hence, it is mutually beneficial. So, how about we keep going? Dividend income is available in several investment alternatives to varying degrees. Probably the most well-liked investment is the S&P 500 index. This is so well-liked because it provides investors with access to 500 sizable US companies with a history of stability and profitability. In addition, it is balanced, meaning that you hold a portion of each area and industry that makes up the stock market as a whole. Because the S&P 500 has a proven track record of generating positive returns, Warren Buffett suggests investing in it. If you buy an ETF or index fund that tracks the S&P 500, you'll get a dividend yield of less than 1.5%. This is what most investors mean when they refer to the market. This is due to the fact that many of the largest shareholdings are technological firms with a reputation for delivering meager or no dividends. With a $5,000 investment, this index would only provide roughly $175 per year, or $6.25 per month in dividends. Another well-liked investment is the Dow Jones Industrial Average, usually referred to as the Dow. Another index that investors frequently refer to as the market is this one. The Dow, which is made up of 30 of the biggest US firms, is often rated second to the S&P 500, is thought of as a secondary barometer of the strength of the US economy. Investors who acquire the Dow fund will earn a dividend that is a little over 1.5%, which is slightly greater than the S&P 500. By making an investment in a fund that prioritizes income over capital gains, one could boost their dividend yield. Stocks of dependable businesses with a lengthy history of dividend payments are among the many high-quality investments available. As an example, consider the Investico S&P 500 High-Dividend Low-Volatility ETF. A dividend yield of almost 4% is the consequence, which is significantly higher than the average dividend yield for the S&P 500. The only companies it holds are those that pay the greatest dividends, as opposed to owning all of the S&P 500 companies. The long-term effect of this is that growth has drastically slowed. The yearly dividend yield on a $5,000 investment in this fund is about $200 or $16.50 per month. Older investors can choose from a wide variety of additional high-dividend funds. Because they offer more stability, they are well-liked by senior citizens. When markets are bearish, they perform better than when they are bullish. These are a prevalent occurrence among retired persons, which is not surprising given their regularity and regular income. Investing in a sector or industry-specific fund is an additional opportunity for investors to receive dividends that are higher than normal. This type of fund solely makes investment in one particular industry or area, such as the production of electricity, real estate, or healthcare. Some industries offer bigger dividends than others due to their particular business models. The energy industry is valued relatively low and has a high dividend yield since many investors are afraid of the fluctuation caused by economic volatility, renewable alternatives, and regulations. The dividend yield of the Vanguard Energy ETF, for instance, is over 3%. The majority of the earnings generated by real estate investment trusts are paid out to shareholders in the form of dividends, making them another relatively hazardous investment type. Additionally, the yield on the Vanguard Real Estate ETF is higher than 3%. The possibility for big profits exists for investors who are prepared to perform studies and buy into markets that are out of favor. Dividends and capital growth will be the forms of rewards when the sectors start to swing back into favor. A $5,000 investment in Vanguard's real estate or energy ETF would generate about $150 in annual income or $25 per month. Yet another alternative is to purchase individual stocks. Nevertheless, if you're a novice investor with a tiny portfolio, many financial experts advise buying index funds or ETFs. Without taking on excessive risk, you can learn about market behavior, generate steady returns, and diversify your holdings. You might ultimately choose specific stocks if you're willing to do the study and take the risk. If you do want to purchase specific equities, you should search for track records and dividend increases. For instance, the list of dividend-paying aristocrats is a fantastic place to start because each of these companies has a history of increasing its dividend for 25 years running. The dividend paid by aristocrat dividend stocks like AbbVie is about 4.5%. If you put $5,000 into this business, you would get about $225 in dividends a year, or $18.50 every month. Additionally, you will receive any capital growth or loss based on the stock's future price. In addition, it would be wise to consider the prospect's fundamentals. In addition to some other potential measures, look for credible payout ratios of 50 to 60% or less positive profits. Due to their propensity for selling off in response to recent bad news, missed earnings, or management changes, individual stocks typically present possibilities for discounts. This can present a chance because the stock market has a propensity to overreact. Before we continue, please feel free to comment below which among these dividends you prefer the most. Or if you know other ones you want to share with us, it would be much appreciated. Done? How about we get going? An intelligent investor will weigh the importance of the news and take autonomous action about the stock price. The majority of investors with $5,000 or less are a long way from retirement, so they should start thinking about completely ignoring dividends. Why? Because investing in growth stocks has the potential to generate substantially greater long-term returns. Historically, the rates of return on dividend-paying investments have been lower. Thus, those who are still young must typically experience growth. A 2% difference in the annual rate of return can have a big impact over the course of a career. For instance, if someone invests $5,000 at age 25 and receives an 8% return until age 65, they will have $108,750. By the time they reach 65, they would have $225,000, or more than twice the amount of money if they had achieved a return of 10%. Growth stocks can be more volatile, which can be difficult for investors who are not accustomed to market changes to manage. For younger investors, an ETF like Vanguard's Growth ETF, VUG, is a fantastic choice. It invests in large-cap growth equities like Apple, Amazon, Home Depot, and other well-known companies, as the name suggests. A growth index is likely to outperform the S&P 500 over the long term, which is great for someone who has a long time before they need income. Due to the fact that the bulk of the holdings pays little or no income, VUG's dividend yield is less than 0.5%. To ensure that the business keeps expanding quickly, they instead reinvest revenues back into it. A $5,000 investment would only return less than $25 in dividends a year, or around $2 per month, due to the low dividend yield. This fund has traditionally beaten the market, but there are many other excellent choices. People are frequently preoccupied with dividend yield and choose investments that aren't appropriate for their time horizons. Overall, it would be wiser for an investor with a $5,000 portfolio to focus on growth and completely disregard dividends. How big of a difference does money, whether it is $25 annually or $200 annually, make in your life? That sum is unlikely to be substantial in terms of covering your everyday expenses and paying bills. Growth stocks would therefore give you a bigger paycheck as you near retirement. Your growth investments could then be changed to income investments if it makes sense to do so. Don't commit the beginner error of concentrating just on a dividend yield. I hope we've enlightened you through this video. So, if you want success in your life and business, make sure to hit that subscribe button if you haven't yet, because we will be uploading more videos like this. Thanks for watching!